February is historically one of the weakest months for markets, but weak months present buy the dip opportunities. Right now, what's holding back the bull market is trade war driven inflation. But this is not 2018, the macro setup is completely different. In this video, I'm going to walk you through why inflation concerns are overblown and why the macro conditions are setting up for a positive surprise. First, we're going to start with investor sentiment indicators. For most of 2024, 75% of stocks were trading above their 200 daily moving average. Today, that number has dropped below 60%. The number of stocks hitting fresh new 30-day highs has cut in half since January. Weekly sentiment surveys suggest investors are becoming less bullish and more bearish. High beta stocks are no longer outperforming low beta stocks, and crypto is underperforming the S&P. And when we add these sentiment indicators together, this is a clear sign that risk appetite has fled the market. But what if I told you this is a good thing? As sentiment gets worse, greed is washed out of the market, all while the macro conditions have improved. And this is what I like to call bullish macro divergence. In other words, the setup for a positive surprise is around the corner as long as tariffs don't turn into a trade war. And because trade war driven inflation is at the top of investor concerns, all we need to do is pay attention to the bond market.